going on, everybody? Dave here, Hidden Freedom Investing, and welcome to another video. In this video, I want to kind of do a fun exercise, and this is the beginning of a brand new series I'm going to do once a month. And what we're going to do here is we're going to look at a way to pay for household products and services that you use every day, and use the dividends to pay for whatever that service or product is that you use. So it's a kind of an interesting way to look at dividends. We're going to call it the Power of Dividends series, and this is the beginning video. So in this first video here, we're going to do Coca-Cola, and then next month we will do a completely different company and a completely different product or service. So hopefully you get something out of this video. If you do, please go ahead and like and subscribe for future videos. I'm also going to create a brand new playlist for this series. So if you're interested in following this series, go ahead and check out that playlist. So let's go ahead and not waste any time. Let's go ahead and get started. Alright everybody, we're looking at my brand new spreadsheet that I created here, Power of Dividends series. So it's just another tab that's in my spreadsheet here, and obviously if you've been following my channel for a while, I have a lot of different spreadsheets, and I actually make them available for purchase if you want them. If not, then that's fine. There's some option stuff there, and options report and all that stuff, amongst a bunch of other things. There's a net worth one in here. And there's also a Roth ladder, nice stuff, and all that I created. So anyways, I created a new tab here called Power of Dividends. And the first product we're going to do here is Coca-Cola. And there's the product on the right-hand side there. I was walking through Wally World the other day, and I snapped this photo. I don't shop a lot at Walmart. I usually like to shop at Walmart just because they're open really late, usually 24 hours, although right now they're only open to 11 o'clock, so I don't go there as much as I used to because I'm kind of a night owl slash vampire. So this picture that I snapped here, $7.88. If you actually look at the description of this label, it says 12 ounce, 24 count, and then this picture up here says 12 ounce and I believe a 12 count. So obviously this label does not go with what this picture is. This product up here I think is in the wrong location. It probably should be way over here or something like that, or maybe you just put two together, and that equals it. So the $7.88 is for a 24 pack, which is double the size of this box up here. But so let's go ahead and take a look here. We got company logo there. Coca-Cola, we got stock ticker Coca-Cola, which is KO. Stock price 54.93. That's the yearly chart right there, and it's been green, so that's kind of good. Stock has remained pretty stable, even though during the pandemic kind of sold off a little bit. Annual dividend is $1.68, and that's paid quarterly. We got the dividend yield there of $3.06%. And if you see these numbers change, by the way, it's just because all this information is pulling from Google Sheets, your Google Finance, dynamically, so it gets updated every 15-20 minutes. So some of these numbers could jump around. Everything is based off of this stock price here, so you could see all these numbers just jump a little bit. That brings down here the company name here, Coca-Cola Company. They are a consumer defensive beverages, non-alcoholic in the USA. Product information, 12 ounce, 24 pack like we were talking about over here. And the product source is Wally World. And then we got the product cost there as $7.88. So what we're going to do here is we're going to figure out how much money we need to invest to support our Coke habit. And what do we mean by that? Not sniffing cocaine off of ass cracks, but actually the drink. So in this case here, $7.88 for a 24 pack. We're going to assume a family of 4 goes through 2 of those in 1 month. So we have the multiplier there is 2. So we're going to times 2 and then times 12 to get our yearly money needed to support our Coke sniffing habit. All right, so we got $189 that we need to support in income from dividends to support our Coke habit. I'm obviously not calculated in taxes or California redemption value or anything like that. Okay, I'm just literally going off the price that they show here without taxes and without the CRV. So what that would bring us to is we take the amount needed in dividends, which is $189 to support our Coke habit, all right, and we divide that by the yearly dividend yield, which is 3.06, and that comes up to $6,183.55. We take that number and we divide it by the current share price, which is $54.93. We come out to 112.57 shares. We need 112.57 shares to support our Coke habit, which will obviously be 6,180. It just went down, so 6183, and that will support our family of 4 with our Coke habit. So obviously if you have a bigger family or you need more Coke, then you could just take this multiplier and times it by 4. If you want to have 424 packs a month, you would need $378 of product per year, 225 shares for a total amount invested in a Coca-Cola stock of $12,364. Let's just go and lower that back to 2 there. The numbers look just more realistic, obviously. So at, family 4, I don't know. Maybe you're just a single person and maybe you go through 224 packs. I don't know. But you can adjust those numbers as you see fit. So we only need $6,182 to basically provide product to support our Coke habit for the rest of our life or for the year. And then you're probably thinking, Dave, what about inflation? How does that affect it? Well, we're going to look at that because obviously inflation is a big concern right now. But we're also going to throw the CAGR in the mix too, because if you're not familiar, most dividend-paying stocks obviously increase their dividend every single year, especially all the dividend aristocrats and dividend kings. Okay, kings are 50 years and consecutive dividend increases, and then the dividend aristocrats are 25 consecutive dividend increases. Coca-Cola happens to be a dividend king, and they have increased their dividend consecutively for 59 years. So what's a dividend? This video is not really to talk about what a dividend is. It's just a portion of the revenue / earnings, a profit that the company pays out in the form of a dividend, and it's to provide a kind of a stable stock / a stable income, kind of an incentive to buy and hold the stock, and that's what kind of dividends are. Some companies pay high dividends, some companies pay low dividends, and some are growth companies. Some are kind of a tweener where they're a growth / a dividend payer. I'd say Coca-Cola is a pretty stable company. They're not really known for growth. They don't really have much growth. And honestly, with a dividend stock, you really care about much growth anyway. The CAGR, we're going to look at that here. We're going to calculate. I'm going to show you how to calculate it. All right, that brings us down here to the CAGR tool. I'm going to show you how to calculate the 5-year CAGR. All these numbers are correct, but I'm going to show you where I got the data from. So for the first, so 2021 we can't technically use yet because it's not a full year of dividends in there yet. So we're going to use 2020. And so we're going to go for 5-year dividend CAGR. CAGR is compound annual growth rate. So we're going to look at the 2015. We're going to go to Seeking Alpha. So Seeking Alpha, we're going to go down here to 2015. By the way, I just have it set to Coca-Cola. So if I scroll up here, you see it set to Coca-Cola. I went to dividend history. And if we scroll down here, we'll go to 2015. So we got basically 33 cents for the entire year. We'll look up a calculator here. So we got 0.33 times 4. We get $1.32 in annual dividends in 2015. We go back to the spreadsheet. So for 2015, starting amount is is $1.32. And then the last full year was 2020. And so we'll look at the 2020 numbers, scroll up here, 2020 numbers, and we got 41 cents. So we got so 41 cents times 4. We get $1.64 in annual dividends. They pay quarterly, by the way. And so we get $1.64. We got obviously calculates the difference for us there. We got 5 years. And Coca-Cola's 5-year compounding annual growth rate is 4.44%. All right, so now we know that what the CAGR for Coca-Cola is on average for the 5 years. That basically means that they increased their dividend on average about 4.44%. So if we take this annual yield up here, or annual dividend, and we times it by 4.44%, that should be about how much the dividend grows every single year. So I kind of populated that number down here. Dividend growth is $1.75. So it basically goes from $1.68 to $1.75. So basically in 2021, we could kind of expect their dividend to kind of get increased. They actually already increased their dividend for 2020, but going into 2022, it should probably go up to about $1.75. And that would raise the yield from 3.06 to 3.19. This is the reason why the CAGR matters, right? So if you notice on my spreadsheet and all the dividend stocks that I have in my portfolio, I got 27 positions. Of course, I have to refresh probably, but look. So right now the CAGR is 5.29, and that's across my whole portfolio, right? So if you go into my portfolio here, and there's all the dividend stocks, and I probably should just refresh because some of the stuff is showing blank. If we scroll over to the right over here, we can see the CAGR. Look, I got the 5-year dividend CAGR there for every one of the positions in there. And on average, I get a 5.29% for my entire portfolio, and that is weighted, okay? So that's the reason why it matters, because what we're gonna see here is we're gonna actually see the yield go up by 5.3%. So if my dividends here, my annual income was what, $22,848. You times that by 5.29%, guess what? So next year, my dividend income should be $24,057. So from 22,848 to 24,057. As long as this is outpacing inflation, your dividends should go up whether you're spending them or not. So if we kind of go by 10 years here, we go, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So basically about 2031. If we actually didn't drip our dividends, our income would still go up from $22,000 to $38,000 if we were not dripping. If we were dripping, that $22,000 would go up to $64,000 annually. And at that point, the 10-year yield on cost would be 7.76. So that is the power of the CAGR right there working for you. As long as that's outpacing inflation, your income should still go up. But I kind of just want to mention the CAGR because it is super important. That's not what this video is about, but that's what that's about there. If you kind of want to look that up, kind of look up dividend CAGR or something like that videos. Do you have a household product you'd like me to do in the next video? Go ahead and comment below. Like and subscribe and hit that bell notification. So Coca-Cola's is pretty low. I would say 4.44% is pretty low, but Coca-Cola is not really much of a growth company, nor is it really grow their dividend much. But still 4.44% is typically more than what inflation is. I have inflation set here at 2%. Inflation is big right now. They're talking about it all over the news, CNBC and all that stuff. The Fed is printing money, and so it's a big concern. I got it set to 2% because that's typically what they always tell you what it is on average, but obviously we could kind of adjust those numbers if we want. We can go up to 4%, we can go to 2%, we can go to 3%. Oops, I screwed up there. So we can go back to 3%, we can go back to 2%. I'm going to keep it 2% just for this demonstration here. So with inflation there, let's just say you're thinking, okay, well, Dave, right now I only need $189 of annual dividend income to support my Coke habit. What if inflation affects me by 2% next year? Well, guess what? You would need $192 of dividend income at that point, which would mean you would need only $6,040 for 109 shares to support your Coke habit if you just got brand new invested next year. And this is always assuming that the stock price stays the same at 54.94. That's what the stock price is right now. And like I said, Google, this could update dynamically from Google as we're talking here. Every 15-20 minutes, these numbers might move. So by the way, this yearly money needed here is including inflation. Okay, so it's including inflation. It's also including the CAGR. So what we're talking about here is we got inflation at 2%. We have the product costs kind of went up because of the 2%. So it costs us, instead of $7.88, and I know Walmart loves those funny numbers, 88 cents and 98 cents and all that stuff, but that would move the product cost to $8.04. So it's going to go up by 10 to 12 cents or something like that. And obviously I can't do the math in my head. I think it's 16 cents if I'm looking at it correctly. So next year, with 2% inflation, we're just going to assume the product cost to go up to $8.04. We times it by 2, we times it by 12. We get $1.92, 192. I always say buck for some reason. Buck just meaning 100. So $192.90. We divide that by our yield, which is 3.19%. We get $6,040, and we divide that by 54.94. We get 109 shares. So that's kind of actually a pretty cool thing there, because we're gonna have money left over. So I had to correct that dripped amount there. It was actually wrong. I had calculation wrong in there. So right now inflation is at 2%, and because of the dividend CAGR being 4.44%, we're going to basically support our need for $192 of product. Would obviously be only $6,000 based on this dividend yield here, 3.19. But because of the CAGR being 4.44%, and which is higher than inflation, we're still going to drip $4.61 back into the stock, which kind of left over. So if we raise this up to 4.44, you basically see the drip amount, like it literally equals itself out, right? So this number equals the number up here. Obviously, the amount needed still goes up, but because the yield went up, because the dividend growth went up, because of the CAGR, it all just equals out, right? So the inflation, even though the product went up, the CAGR went up 4.44% as well, which kind of counteracts the inflation, which means we won't drip anything. Obviously, the numbers are rounded up or down, so it's just showing 1 cent. But if we lower this back down to, let's say 2, we come back out to $4.61 of drip. If we say, let's just say there is no inflation, so we go 0, we would actually drip in, not only the product remains the same, but because of the CAGR going up, which increases the amount of annual dividends, we drip back into the stock $8.39. And obviously inflation is not 0, but Coca-cola, I don't think inflation really goes up very much, but we're gonna put it at 2% because that's pretty standard. So I hope you enjoyed this first video in this series. This kind of gives you an idea, the power of dividends, right? $6,000 invested basically in Coca-Cola, and you can provide your snorting habit the rest of your life if you want. That's including with inflation. And that is assuming that Coca-Cola keeps their 5-year compound annual growth rate about 4.44%, around 5% or so. You can play with those numbers if you want. So anyways, if you enjoyed this type of video, I'm going to be doing another one next month. I'm just going to pick a product at random that you might actually use in your house. So if you have any comments, questions, or concerns, please leave a comment below. Hit me up on Facegram or Twitter, or you can shoot me an email if you want as well. So until next time, go ahead and like and subscribe. We'll see you next video. Thanks for watching.